The Rebel Capitalist Show.
Okay, so we understand the system, we understand some of the negative unintended consequences, but now you're saying that this petrodollar system is starting to deteriorate. So I'm specifically at your subtitle in the post where you're talking about the fraying of the petrodollar system. So
Yeah.
kind of take us through what you see playing out in the future.
Yeah, so there are a couple big forces happening. One is that, even within the system, we generally have these big like 15-year dollar cycles. And so every 15 years ago or so, we tend to have a big shift in fiscal monetary policy. We start to get a much stronger dollar. And then usually what happens is foreigners buy fewer treasuries. We end up having to finance more of our deficits. And we end up, trade slows. The dollar becomes very strong. It makes our exports even less competitive, and we generally get kind of a flat line in corporate profits, and we usually then see a shift. We see more dovish monetary policy or a recession, whatever the case may be, and that as that kind of resolves, we generally see a weaker dollar. And so we've had really three really big dollar cycles within this past 50-year monetary system. And of course, just because you have a bear market in the dollar does not mean that the dollar is losing global reserve status, right? So I think one thing I try to point out in that post is a dollar bear market is not the same thing as losing dollar reserve status. So we've
Right.
had three major bear markets in the dollar without losing any degree of that status. So a couple structural shifts are happening currently that are different from what happened in those cycles. And so one is that we don't have as much foreign demand for treasuries as we used to. And there's a couple. It's largely centered on China, but there's a couple reasons for it. And so, in the early stages of this, Europe was one of our biggest trading partners. So, we would run persistent trade deficits with Europe. They would get all these dollars, and they would reinvest those dollars into treasuries and hold them as, foreign exchange reserves. And then, Japan, we had the big, rise of Japan in the 70s and the 80s. And so they started to run really big trade deficits with us. They would get all these dollars and they would invest those dollars in treasuries and hold them as their foreign exchange reserves. And so that's why, even though the U.S. is running persistent trade deficits, we're still benefiting in some ways because foreigners are financing our deficits more so than most other developed countries.
Right.
And
Keeping the interest rates low. That's
yeah,
key, because going back to what you're saying, although real wages have really plateaued, we haven't had too much of a squeeze because we've been able to, asset prices have gone up and the cost of buying a home has gone down, even though prices go up because the mortgage payment goes down, because interest rates go down. And then so debt in our system becomes a lot cheaper as a result of this foreign demand for treasuries.
Yeah, and it's also, I mean, it's not just interest rate because, for example, if you look at Japan, they've had lower interest rates than us. A lot of it has to do with the quantity of capital. So, for example, if you don't have foreign demand, you're not doing QE, then if the federal government were to run deficits, that means that someone else in the domestic economy is buying those treasuries. So
Right.
we're sucking capital out of one part of the system and injecting it into another part of the system. But if foreigners are buying our treasuries,
Mhm.
that we're not sucking dollars out of anywhere in the domestic economy, at least on net. And
Right.
instead, we're getting this kind of, our trade deficits being recycled back into our deficits.
Right.
And
Those domestic dollars can be reinvested, where if it was just all domestic demand for treasuries, then they wouldn't be able to be reinvested by the producers who are
yeah,
earning them in the first place. Yeah, got it.
yeah. So we've been able to run bigger deficits. We've been able to, get away with get kind of more kind of a looser fiscal policy. And so then in the past 20 years, we've seen the rise of China. And, for the first 15 years or so, they were on the same course where they would run persistent trade deficits with us, take all those dollars and reinvest them and hold a ton of treasuries. They accumulated well over $1 trillion worth of treasuries. But then in 2013, they said it's really no longer in our best interest to keep buying treasuries. And instead, they launched the Belt and Road Initiative. So they were still running these big dollar surpluses. It kind of flatlined over time, but they were still having a strongly dollar positive position. But instead of buying more treasuries, they actually slowly reduced their treasuries, and instead they invested in dollar-based loans around the world. Developing countries in Africa, Eastern Europe, the rest of Asia, Latin America, and a lot of them were commodity related.
Yeah, right.
And it's because China, of course, is a very large commodity importer, including oil. And so, part of this was infrastructure and commodities centered around, basically exporting Chinese know-how, right? Because they're pretty good at infrastructure. So the combination of financing and technical, infrastructure development, and then in return they get all this, these trade partnerships. They get these, commodity rights, things like that. And so we've been in a situation where foreigners are not really buying our treasuries to the extent that they used to.
Right. And that doesn't even include all the private Chinese investment. I remember, I think I tweeted something about your article, and I think I tweeted one of your charts that shows all of the loans that have been made, the dollar-denominated loans by the Chinese. And someone said, well, yeah, but there's nothing in Vancouver, Canada. I said, yeah, these are just dollar loans. These aren't private investments. If it had the
Yeah.
private investments on there, it would be even more sobering than it is
Yep.
just looking at the dollar-denominated loans they've extended.
Yep. Yeah. And yeah, the ones in Vancouver, because they're not loans, they're buying assets, they're buying, properties. And so yeah, that chart only shows a subset, as you mentioned. And so that's the one structural thing we've been seeing, is that we're not seeing this kind of newfound source of demand for treasuries like we did after Europe with Japan and after Japan with China. There's really kind of no one left here. A second thing we're seeing is that because the United States has decreased as a percentage of global GDP over time, mainly because of the
Yeah.
rise of China and other emerging markets, there's just not a lot of dollars in the system. And I know you've had Jeff Snyder on a number of times, and we're always talking about this dollar shortage, right?
Yeah.
So what
I
are some
just
of the
talked to Brent too.
Yeah, exactly. And so it's like, what are the reasons for this dollar shortage? And a lot of it has to do with how much dollar-denominated debts there are, how the euro-dollar system structured. There's all, we all have different expertise. We focus on different areas. A lot of it also has to do with the shale oil boom in the U.S. Because that somewhat controlled our trade deficits over the past decade. And so we've had kind of a flatlining trade deficit.
In other words, it reduced them because we were exporting so much oil. Is that correct?
More like we exported some, but we also were able to import less than we would otherwise have had to.
Okay.
And so that's persisted. So the combination of the U.S. is shrinking as a percentage of global GDP. We became a little bit more energy self-sufficient, and that's not really good for the offshore dollar market. And in addition, now that we've seen the rise of China as kind of an economic competitor, they're actually importing more commodities than we are, and yet
Right.
they're still generally doing it in dollars, and so that's not a very advantageous position for them. And so we've seen, for example, Russia's been very persistent in wanting to price their oil in euros rather than dollars.
Mhm.
And over the past 2 or 3 years, they've been very successful in that. They de-dollarized their foreign exchange reserves, right? So they sold most of their treasuries. They started putting most of it into gold, and they've been selling their oil and gas to Europe and China largely in euros. And so we've seen a rapid rise in euro pricing and a decrease in dollar pricing for their energy.
Yeah.
Russia's also been successful in doing that with India. And so if you just look at, Russia with Europe, Russia with China, Russia with India, we're seeing de-dollarization. And so
Yeah.
all these kind of energy importers are, we're starting to see around the edges that the petrodollar system no longer has that complete lock on the global energy market that it once had.
I'm looking at a chart that's basically outlining what you're talking about from your report. And just to be clear, when you're talking about China as an example, paying for Russian exports in euros instead of dollars, just to give people some context, and editor, you can throw this up, but 6 years ago, 98% of the transactions were done in dollars. And as of 2020, only 33% are done in dollars between China and Russia. Just wanted to throw that in there so people understand the magnitude of what you're talking about.
Yeah, it's been a very large shift, and of course now that was really before that the Chinese digital currency was launched, and so we're gonna have to see over the next couple of years if that might further accelerate it. In addition, on that chart, even though the euro has kind of become kind of a regional currency for energy pricing among those countries, we're also seeing increased trade with their local currency, so increased rubles and yuan. And so
Right.
it'll be interesting to see if China can increase the usage of their digital currency with some of their trading partners.
Yeah. How do you see that working out? I don't want to go too far down that rabbit hole, but how would this Belt and Road Initiative and what we're seeing with kind of the decentralization from the petrodollar system, how would that play into China advancing the digital yuan as potentially the next global currency? And I'm not saying that's happening tomorrow or next year, but maybe 5 years, 10 years, maybe decades into the future. How does that it all play into that network effect to where people in Africa, South America, Eastern Europe, India would start choosing to use the digital yuan instead of the dollar or whatever other alternative there is?
So I think it'll mostly be restricted to international trade, but there are, of course, a couple different areas where they could use it. One thing I've been emphasizing is a lot of people ask if the dollar were to, over time lose its global reserve currency status, what would replace it, right? Would it be the euro? Would it be the yuan? And my answer has always been no. There's not, there's no country large enough to be the axiom of the system like the
Right.
U.S. was in a post-World War II environment. So there's no country that's 35 to 45% of global GDP. And so the United States isn't big enough to do it anymore. China's not big enough. Europe's not big enough. And so my base case is that we're going to see more and more decentralization. So it makes sense, for example, Russia to sell oil in the currencies of their peers rather than sell them in dollars to places that that are based in euros or yuan. And so we'll see Eurasia generally de-dollarize to some extent. Latin America is somewhat more in the dollar sphere. So it kind of depends on regional sources of power.
Mm.
But overall, with China being the biggest importer of energy, that gives them a lot of influence over some of their energy partners and some of their commodity partners, for example. So they can, for example, try to have their yuan increasingly used for some of their imports. And of course, those countries, they like some of China's exports. They like some of their technology. They like some of their manufactured goods. And so that basically, there's even if they might not want to hold those as reserves, they know that they can cycle those back into buying goods and services from China. And so my base case over time is that we'll see a little bit more usage of Chinese currency, with specifically with some of their commodity, import agreements.
Yeah.
And so it's not that really China wants to displace the dollar, it's that they want to de-dollarize their import costs.
Yeah, got it. Okay, so the bottom line, I think the takeaway there for the viewer is you see dollars being used in the global monetary system less and less over time. It's not
As a
something that happens over
as a percentage, yeah.
just as a percentage. Okay.